7 common mistakes in mining investment research, and how to avoid them. Mining investment research is crucial but often mishandled, leading to costly errors before a single dollar is invested. Here are 7 common mistakes analysts and enthusiasts make, and how to avoid them. 1. Overlooking geological data. Too many rely solely on company press releases without digging into detailed geological reports. Understanding ore grades, deposit size, and mineralogy is foundational. Always consult technical reports like NI 43-101 or JORC for reliable data. 2. Ignoring operational risks. Research often ignores operational factors like mining methods, infrastructure, and geopolitical risks that can drastically affect project viability. Comprehensive due diligence must include these non-technical elements. 3. Misinterpreting production costs. Mining companies report various cost metrics: cash cost, all-in sustaining cost, AISC, and total cost per ounce. Confusing or overlooking these differences skews profitability analysis. Know what each cost figure represents. 4. Neglecting resource and reserve updates. Resource estimates evolve as projects advance. Failing to track updated reports can mislead on a mine's future potential. Always check the latest filings and technical updates. 5. Over-relying on market sentiment. Price movements often reflect speculation rather than fundamentals. Research must focus on objective data, not hype cycles or short-term market noise. 6. Skipping environmental and social impact reviews. Sustainability is no longer optional. Ignoring environmental permits, community relations, and ESG reports risks underestimating project delays or opposition. 7. Failing to cross-verify sources. Mining data can be complex and sometimes inconsistent. Cross-reference multiple independent sources, company filings, government databases, and industry reports to ensure accuracy. Mining research starts and ends with solid research. Anna Lees for Skillings.net.